Welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. So in our last episode, we did an immediate reaction to the April FOMC meeting by the Federal Reserve in terms of their policy outlook. We also discussed the situation in the Middle East as well as the U.S. earnings results so far. Now, in this episode, I want to take a step back and also look at the broader central banking community and how they are thinking the handling of the situation with the U.S. Iran war, and obviously, the more importantly, the fresh supply side shocks, namely the supply chain disruptions that could come as a result of the supply disruptions when it comes to energy, as well as related petrochemicals, and also the rising risk of stagflation. So what we'll do this episode is to go through the U.S. Federal Reserve's thinking one more time, but also take into consideration the reaction functions by the European Central Bank, the Bank of England, and the Bank of Japan, who all held a meeting last week, as well as some of the Asia and emerging market central banks that have discussed policies in the past week or so. So let's start with the United States. The Federal Reserve's Policy Setting Committee, or the FOMC, held rates steady at 3.5% to 3.75%, exactly as the market expected. But the wording does matter. In a statement, the Fed upgraded its description of inflation from somewhat elevated to simply elevated, and explicitly noted that inflation is being driven in part by the recent increase in global energy prices. And that's not so subtle. That's a direct acknowledgement that oil shock is here and is showing up in the inflation story. We already start to see that in the March inflation numbers. Now, there is a notable split inside the Fed. The committee kept an easing bias in its outlook, but 3 voting members objected to keeping that easing bias, even though they did agree with holding rates steady. Their argument: the inflation backdrop no longer justifies this lean towards dovishness in terms of policy thinking. Now, that disagreement is important for me because it's not just drama, but there's a signal, a public reminder that policy is being argued on data, not dictated by politics. Now, for the press conference, Chair Jay Powell reinforced the balancing act on tariff. He stuck with his view tariff is more likely to be a one-time price level increase, not necessarily the start of an ongoing inflation cycle. But energy could be different. With oil prices spiking and the uncertainty about how long this disruption could last and how much they could seep into inflation expectations, Chair Powell suggests that the Fed has the reasons to be more cautious, in other words, more waiting, more watching. And Chair Jay Powell also addressed his own future, confirming that he will remain on the board after his chair term ends on the 15th of May for a period to be determined, citing legal attacks against the Fed. Meanwhile, he said he intends to keep a low profile supporting incoming chair Kevin Walsh and avoid becoming a shadow chair. So what does that mean for Fed's policy going forward? Now, our expectation is that the Fed will stay on hold for the foreseeable future. Inflation pressures push against a dovish tilt, but the bar for raising rates is still relatively high. The committee sees policy as near neutral, which buys time while the conflict and the spillovers play out. The labor market matters here. The jobless rate is relatively low, but the no hire, no fire dynamic means wage growth is also modest and not currently fueling demand-driven inflation problems. Still, the range of outcome is wider than it was a few months ago. Market pricing has turned more hawkish. The implied probability of a hike by April next year is around 40%, a sharp contrast from expectations of no change until the summer of 2027 before we go into this meeting. Moving across the Atlantic to Europe and the UK, where the debate is less about tariffs and more about one crucial question: do high energy prices trigger a second-round effect? Now, do households and businesses begin to behave as if inflation will persist, driving wage demands and pricing decisions that could make inflation self-sustaining? For the Bank of England, policymakers held rates unchanged at an 8-1 vote, with a hawkish dissent from Pill. Governor Bailey described the stance as an active hold, the idea that tighter financial conditions should help to curb inflation in the near term, while the Bank of England buys time to evaluate the next batch of data. But, and this is key, The Bank of England also retained a tightening bias, reiterating that it stands ready to act to ensure inflation returns to that 2% target over the medium term. Over the ECB, the European Central Bank held rates unchanged also for the 8th consecutive meeting, keeping deposit rates at 2%. Now, without a new staff projections, the meeting debates really turned to whether a hike in June is on the table. President Lagarde noted that the March projections already had 2 hikes factored in, so a near-term hike will be consistent with the ECB's own framework. Now, markets are trying to interpret all this in real time. In the UK, views inside the committee appears to be sharply divided, doves leaning towards a benign temporary energy shock, while the hawks emphasizing the upside risks and persistence in inflation pressure. Markets have pared back BOE hiking expectations, with about 60 basis points priced in by the end of the year and a sharply lower probability of a near-term hike. In the euro area, markets are pricing in more aggressive path. 1 hike by June and a total of 3 hikes by December. But the plausible baseline is still that the ECB will stay on hold if the situation de-escalates and energy flows normalize through May. Moving towards Japan, the Bank of Japan held policy rates at 0.75%, but the dissent widened to a 6-3 vote, a sign of increasing internal disagreement as the risk of inflation starts to shift. Now, forecasts have incorporated Middle East risks more fully. Lower growth, high inflation, guidance leaned towards opening the door to a hike in June, but with less conviction on the exact timing. Given the expectation for a hike in the next couple of months, a second move in the second half of the year, October or December, would depend on the data and the lagged effect of prior tightening. Now, one huge constraint, which is the dollar-yen exchange rate, is increasingly shaped by the global conditions and also the Fed stance. And of course, the Bank of Japan have to take into account the reliance on imported energy. It arguably faces a greater stagflation dilemma than the U.S. or Europe, meaning a central bank has to move with more caution. So what does that all mean for investors? In many ways, fixed income investors are facing the same crossroads as central bankers. The Big Four, the Fed, the ECB, the Bank of England, and the Bank of Japan, are essentially holding their breath, watching developments in the Middle East, and try to navigate a policy environment that could become much more complicated. Meanwhile, some central banks don't necessarily have the luxury of time. Emerging markets and parts of Asia may be forced to act sooner. In April, Singapore and the Philippines tightened, and officials at the Bank of Korea have signaled that higher rates may be needed to cool inflation. In other developed economies, the Reserve Bank of Australia also raised rate this week, although it may be on pause for the time being. In the near term, inflation risks looks more prominent globally. Energy prices are up, and food production faces risks from disrupted fertilizer supplies and rising transportation costs. But there's also an even more challenging scenario. If the Strait of Hormuz stays closed for longer, demand destruction could spread and threaten growth more broadly. This creates a very challenging setup for government bond curves, especially the longer end. Rates could rise first on inflation fear and then fall when growth momentum starts to crack. This is the whipsaw that investors have to work with. One implication, a curve flattener may be a relatively cheaper hedge for this kind of volatility, hedging inflation from supply-side shocks without going outright long duration. So central banks are pausing for now with vigilance. The next move depends on whether the energy shock fades or become embedded through expectations and second-round effects. As for markets, that means living with a wider distribution of outcomes and more two-way volatilities. As always, diversification and income are crucial ways to handle this type of challenging environment. Thanks for listening. I hope you found this useful. If you do, feel free to share this with your friends and colleagues. And of course, consider subscribing. If you have any additional questions on this podcast or about markets in general, feel free to reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you next time to discuss what's on investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.